Let me tell you something that took me 10 years to learn. Something your bank will never put in a headline and your employer will never put in the onboarding packet. Right now, somewhere in this country, there are two people. Same age, same salary, same starting point. One of them is going to retire with $4 million. The other is going to retire with $87,000. The difference between them has nothing to do with luck, nothing to do with the stock market crashing or booming. It has everything to do with one decision made in one afternoon. That one of them made and the other one didn't. That decision is what this entire video is about. I'm going to show you exactly what I would do if I were starting from zero in 2026. And I'm going to make sure that by the end of this video, you are the person with $4 million. Here's the honest reason most people never invest. It's not that they're irresponsible, it's not that they don't have the money, it's that nobody ever explained it in plain English. When you Google how to invest, you get hit with a wall of words that feel like a different language. ETFs, index funds, brokerage accounts, Roth IRA, dollar cost averaging, expense ratios. It sounds complicated on purpose. And the financial industry, to be honest, has never had a great incentive to make it simple. The more confused you are, the more you pay someone else to manage your money, and they take a percentage of everything you have every single year, whether you make money or not. So before we get into the how, I want you to understand that this is not complicated. Everything I'm going to show you today, a motivated 16-year-old could understand in one afternoon. And by the end of this video, you will have no more excuses. So why invest at all? I mean, can't you just keep your money in the bank and call it a day? You could, but here's what that actually means. The average savings account in the US pays you about 0.5% per year in interest. Inflation, the rate at which prices go up every year, runs at roughly 3% per year on average. That means every single year your money sits in a bank account doing nothing, it quietly loses about 2.5% of its real value. Think about it this way. In 2010, a movie ticket cost about $8. Today, it's over $15. The dollar in your pocket today will buy less and less every single year for the rest of your life. Your savings account is not protecting you. It's just slowly bleeding you. And this is before we even talk about what investing can do on the positive side. The US stock market, the whole thing top to bottom, has returned an average of 8 to 10% per year over the last 80 years. That means your money doesn't just keep up with inflation, it laps it. Now, I want to show you the single most powerful concept in personal finance. It's called compound interest, and once you truly understand it, you will never want to wait another day to start investing. Here's how it works. Imagine you put $1,000 into an investment that earns 10% per year. After year one, you have $1,100, but in year two, you don't earn 10% on the original $1,000. You earn 10% on $1,100. So now you have $1,210. In year three, 10% on $1,210, and so on and so on. After 20 years of doing absolutely nothing, no extra contributions, just letting it sit, that $1,000 becomes $6,727. After 30 years, $17,449 after 40 years, $45,259, $1,000. One afternoon. 40 years of patience. You didn't work for that money, your money worked for you. And that's the whole game. Okay, so we know we want our money to grow faster than inflation, and we know compound interest is the engine. Now the question is, where do we actually put the money? You could invest in real estate, you could buy gold, you could buy art, collectibles, crypto, a small business. All of these can work, but for someone starting in 2026 with no prior experience, stocks are the single best option. And here's exactly why. First, accessibility. You can open an investment account from your phone in about 15 minutes and buy your first stock for as little as $1. Try doing that with real estate. Second, liquidity. If you buy a house and need the money back tomorrow, you're stuck. If you buy a stock and need the money back tomorrow, you sell it and the cash is in your account within 2 business days. Third, consistency. Over any 20-year period in history, the US stock market has never produced a negative return. Never. Not once. You can't say that about any other major asset class. When I say the stock market, most people picture a chaotic trading floor with people shouting and numbers flying everywhere. That's not what you're going to be doing. What you're going to be doing is buying a tiny piece of the 500 largest companies in the United States, all at once with a single purchase. This is called the S&P 500, and EP stands for Standard & Poor's, which is just the company that maintains the list. Think of it as a basket. Inside that basket are Apple, Microsoft, Nvidia, Amazon, Google, Berkshire Hathaway, and 494 other companies. When you buy one share of an S&P 500 index fund, you instantly own a tiny fraction of all 500 of them. Why does this matter? Because even if 50 of those companies go bankrupt tomorrow, the other 450 keep going. You're not betting on one horse, you're betting on the entire race. Now, someone in the comments is already typing, why not just buy Nvidia? It went up 500% last year, and you're right. If you had bought Nvidia 5 years ago, you would have crushed the S&P 500. But here's the question, did you know 5 years ago that Nvidia was going to be Nvidia? No, you didn't. Neither did most professional fund managers. Here's a stat that should end this debate for you. Over a 20-year period, more than 90% of actively managed funds run by trained professionals with research teams, Bloomberg terminals, and millions of dollars of resources failed to beat a simple S&P 500 index fund. 90% failed to beat a fund that literally just buys everything and does nothing. Picking stocks is gambling with extra steps. Buying the whole market is not gambling. It's participating in the growth of the entire economy. All right, let's clear up the most confused term in beginner investing ETF. It stands for Exchange Traded Fund. That sounds technical, but the concept is dead simple. An ETF is just a basket of investments that you can buy and sell on the stock market like a regular stock. That's it. When an ETF tracks the S&P 500, it holds all 500 stocks in proportion to their size. The bigger the company, the bigger its share in the fund. The most popular S&P 500 ETFs are VOO from Vanguard, SPY from State Street, and IVV from BlackRock. Any of these will do the same thing, give you instant exposure to the 500 largest US companies for a fraction of a percent in annual fees. You don't need to memorize the difference between every type of fund today. Just remember this. When someone says buy an index fund or buy an ETF, they are almost always telling you to do the same thing in two different words. Before you can buy a single share of anything, you need to open an investment account. This is just like opening a bank account, except it's specifically built to hold investments. There are two main types you need to know about. First, a retirement account. In the US, this is usually a 401k or an IRA. A 401k is sponsored by your employer. They set it up, and sometimes they even match a portion of what you contribute. That match is free money. If your employer offers a 401k match and you're not using it, you are leaving free money on the table every single pay period. An IRA, individual retirement account, is one you open yourself, independently. Both come with tax advantages. In a Roth IRA, you pay taxes on the money now, but all the growth is tax-free forever. In a traditional IRA, you get a tax deduction today, but pay taxes when you withdraw in retirement. The second type is a regular brokerage account, no tax perks, but also no restrictions on when you can take your money out. Once you know which type of account you want, the next step is picking where to open it. These are called brokerages, platforms where you actually place your investments. The good news is you do not need to call anyone. You do not need a financial advisor. You do not need to leave your house. You just need 15 minutes and your phone. The three most popular options in the US right now are Fidelity, Charles Schwab, and Robinhood. Fidelity and Schwab are the old reliable options. They have excellent customer service, zero commission trades, and decades of trust behind them. Robinhood is newer, cleaner, and frankly better designed for beginners, though it has fewer account types. My personal pick for someone starting in 2026. Fidelity, it has everything. Retirement accounts, brokerage accounts, fractional shares, zero commission. And it's not going to gamify your investing the way some newer apps do. Pick one, open an account, fund it with whatever you can afford. That's it. One of the most common things I hear is, I'll start investing when I have more money. And I'm going to tell you right now, that's the most expensive sentence you will ever say. Here's the math. Let's say two people both decide to invest $200 a month. Person A starts at age 22. Person B starts at age 32. By age 62, person A has about 1 million. Person B has about $490,000. Person B invested the same monthly amount, just started 10 years later, and ended up with $500,000 less. You don't need to be rich to start investing. Most major platforms now allow you to buy fractional shares, meaning you can buy $5 worth of Amazon, $10 worth of an S&P 500 ETF, or literally one of anything. The amount matters far less than the habit. Get the habit started. Scale the amount up as your income grows. Now, let's talk about the smartest, simplest strategy for investing consistently. And it works whether the market is up, down, or going sideways. It's called dollar cost averaging, and it's essentially the investing equivalent of autopilot. Here's how it works. Instead of trying to time the market, trying to guess when prices are low enough to buy, you invest the same fixed amount at the same time every month, no matter what. Set it and forget it. When the market is down, your fixed amount buys more shares. When the market is up, it buys fewer. Over time, this averages out your purchase price and removes the single biggest enemy of beginner investors' emotion. Because the truth is, when the market drops 20%, your emotions will tell you to sell everything and run. Dollar cost averaging removes that temptation. You're not checking the market, you're not panicking. You set a rule in January and you follow it for 30 years. That rule will make you wealthy. Let me tell you about one of the most expensive myths in investing, the idea that you should wait for the right time to buy. Every year, experts predict corrections. Every year, smart people wait for a crash that may or may not come. And every year, the people who stayed invested quietly got richer while the people who waited got nothing. Here's the data. If you invested $10,000 in the S&P 500 in 1993 and just left it alone, you'd have about $240,000 today. If you tried to be clever and accidentally missed just the 10 best days in those 30 years, you'd have $110,000. Missed the 20 best days, $60,000. Missed the 30 best days, $33,000. The best days always come after the worst days, and you never know when they're coming. The best time to invest was 10 years ago. The second best time is today. Investing involves risk. I'm not going to pretend otherwise. There will be years where your account drops 20%, 30%, even 40%. In 2008, the S&P 500 fell nearly 50%. In 2020, it crashed 34% in a single month. But here's the thing that nobody tells you: those drops only become permanent losses if you sell. If you just leave the money alone, history shows the market has recovered every single time. Every single time. The question isn't whether the market will go down. It will. The question is whether you'll panic and sell when it does. And the honest answer to that is, if you understand that drops are temporary and recoveries are inevitable, you'll be far less likely to panic. Think of it this way. If the price of your house dropped by 30% next month, would you immediately sell it for a loss? Of course not. You'd wait. Treat your investments the same way. Not everyone should invest the same way. Your investing strategy should fit your life, specifically how much time you have before you need the money and how much stress you can handle without making emotional decisions. If you're in your 20s or 30s, you have 30 or 40 years before retirement. A temporary 40% drop doesn't destroy you. You have decades to recover. In this case, you can afford to be aggressive, mostly stocks, mostly S&P 500 ETFs. If you're in your 50s or 60s, a 40% drop is a lot scarier because you might need that money in 5 or 10 years. In this case, you gradually shift toward more conservative investments, a mix of stocks and bonds, so that a market crash doesn't derail your retirement. The general rule of thumb is take 110 and subtract your age. That's roughly the percentage of your portfolio that should be in stocks. At age 30, that's 80%. At age 60, that's 50%. Here is the single change that will have the biggest impact on your investing life. Automate it. Set up an automatic transfer from your bank account to your investment account every month, the same day your paycheck arrives. Don't think about it. Don't look at the market first. Don't wait to see if you have money left over. Move the money first and live on what remains. This is what financial advisors call paying yourself first. Your bills, your rent, your groceries, those come after your investment, not before. Because if you wait until after, there's always a reason the money didn't make it. Most brokerages make this incredibly easy. On Fidelity, Schwab, and Robinhood, you can set up a recurring investment in under 5 minutes. Pick an ETF, pick an amount, pick a frequency, done. Your future self will thank you more for this than any stock tip you'll ever hear. I want to talk about something that most beginners completely overlook, and it will cost you more money than almost any bad stock pick you'll ever make. I'm talking about fees. Every investment fund charges a fee called an expense ratio. It's a small annual percentage taken from your investment automatically. You never see a bill. It just quietly disappears from your account every year. Here's why this matters. A fund with a 1% expense ratio sounds cheap. But over 30 years on a $100,000 investment, that 1% fee costs you approximately $130,000 in lost returns compared to a fund charging 0.03%. The S&P 500 ETF from Vanguard VOO charges 0.03% per year. That is effectively free. Meanwhile, many actively managed mutual funds charge 1% or more for worse performance. That is the definition of a bad deal. Always check the expense ratio before you buy any fund. If it's above 0.2%, you better have a very good reason why. You've probably heard the phrase, don't put all your eggs in one basket. In investing, this is called diversification, and it's arguably the most important risk management tool you have. When you buy an S&P 500 ETF, you're already diversified across 500 companies in dozens of industries. But you could take it a step further. You might also consider a total international stock market fund, which gives you exposure to companies in Europe, Asia, and emerging markets, or a total bond market fund for stability as you get older. A simple 3-fund portfolio, US stocks, international stocks, bonds, is what legendary investors like John Bogle and Warren Buffett have both recommended for ordinary people. It's simple, it's low cost, and it's proven. You don't need 50 funds, you don't need a financial advisor to build this. You need 3 ETFs and the discipline to leave them alone. Here's what nobody teaches you in investing. The hardest part is not choosing the right fund. The hardest part is your brain. Human beings are wired to react to loss more strongly than to gain. Studies show that losing $100 hurts about twice as much psychologically as gaining $100 feels good. This is called loss aversion, and it causes investors to panic sell at exactly the wrong moment. There's also something called recency bias, the tendency to assume that whatever just happened will keep happening. When the market crashes, your brain says it'll keep falling. When the market is booming, your brain says it'll keep rising. Both are wrong, both lead to bad decisions. The antidote: a system that removes you from the equation. Automate, diversify. Set a plan and commit to not checking your account every day. The single biggest predictor of investment success isn't intelligence, it's the ability to stay calm and stay consistent. Let's talk about taxes, because if you invest in a regular brokerage account, the government wants a piece of your profits, and the rules are actually simpler than most people think. There are 2 types of capital gains tax. Short-term capital gains apply to investments you've held for less than 1 year. These are taxed at your ordinary income rate, which could be as high as 37%. Long-term capital gains apply to investments you've held for more than 1 year. These are taxed at a much lower rate, 0%, 15%, or 20% depending on your income. This is yet another reason why long-term investing beats short-term trading. Not only are you more likely to make money by holding, but you also pay less in taxes when you eventually sell. And of course, inside a Roth IRA, you pay 0 capital gains tax on any of it, ever. That's why maxing out your Roth IRA before investing in a taxable brokerage account is almost always the right move. Before I show you the live step-by-step setup, I want to run through the 5 most common mistakes beginners make so you don't have to learn these the expensive way. Mistake 1, waiting for the perfect time. There is no perfect time. There's only now. Mistake 2, checking your account every day. This will drive you insane and push you to make emotional decisions. Check once a quarter, maximum. Mistake 3, chasing trending stocks. GameStop, meme coins, hot tips. This is a casino, not a strategy. Mistake 4, ignoring your employer's 401k match. This is the highest guaranteed return available to you. Use it first. Mistake 5, not increasing your contributions as your income grows. The amount you invest at 25 should not be the same amount you invest at 35. As you earn more, invest more. Every raise is an opportunity to upgrade your future. Let me show you exactly what the path to $1 million looks like in real numbers, because I want this to stop feeling like a distant fantasy and start feeling like a math problem you can solve. If you invest $500 a month starting at age 25, assuming an 8% average annual return, you reach $1 million by age 57. That's 32 years of consistent investing. If you invest $500 a month starting at age 35, you reach $1 million by age 68. That's 10 years later for the exact same effort. If you invest $1,000 a month starting at age 25, you hit $1 million by age 49. That's 24 years. You could be a millionaire before 50. These are not projections based on lucky stock picks. This is just math. Compound interest, index funds, consistency, no special knowledge required. The only variable is when you start and how much you put in. All right, this is the moment of truth. Let me walk you through exactly how to place your first investment, step by step. I'm going to assume you chose Fidelity. Step 1, go to fidelity.com and click open an account. Choose either a Roth IRA if you have earned income or a regular brokerage account if you just want to start immediately. Fill in your basic information: name, social security number, address. It takes about 10 minutes. Step 2, fund your account link your bank account and transfer the amount you want to start with. Even $50 works. Step 3, search for VOO, the Vanguard S&P 500 ETF. You can buy fractional shares. So if VOO is trading at $500 per share, you can still buy $50 worth. You'll just own 1/10 of a share. Step 4, choose buy and select either a market order, buys immediately at the current price, or a limit order sets a maximum price you're willing to pay. For a beginner, market order is fine. Step 5, confirm the order. You're done. You are now an investor. You placed your first investment. Now what? First, set up automatic monthly contributions. Go into your brokerage's recurring investment feature and set up the same purchase every month. Pick a date, pick an amount, lock it in, never touch it. Second, max out tax-advantaged accounts in order. Start with your 401k, at least up to your employer's match. Then max out your Roth IRA, $7,000 per year in 2026 if you're under 50, $8,000 if you're over 50. Then invest any remaining cash in a regular brokerage account. Third, increase your contribution every single year. Even a 1% increase per year compounds dramatically over time. Automate that too, if your platform allows it. Fourth, keep educating yourself. Not to change what you're doing, but to stay confident enough not to panic when things get rough. Read one book on personal finance per year. I'll leave my recommendations in the description. Fifth, be patient. That's the whole game. I want to end this video the same way I started it, with two people, same age, same salary, same starting point. The only thing that separates the person with $1.4 million from the person with $87,000 is this. One of them watched a video like this one and then actually did something about it. And the other one said, I'll get to it later. Later is the most expensive word in personal finance. Every month you wait to start is a month of compound interest you'll never get back. Every year you leave your money sitting in a savings account at 0.5%. Inflation is quietly shrinking it. The information you need is no longer the problem. You now have it. The only question is whether you'll act on it. Close this video, open Fidelity, transfer $50. Buy $1 cost average position in VOO. Set it to repeat every month. And then most importantly, forget about it. Come back in 30 years and thank yourself. I'll see you there.